Are stocks overpriced, or maybe they're underpriced, or maybe they're priced just right? Should we be looking at the price earnings multiples? Justin Lahart of the Herd on the Street team is here to tell me, well, maybe you can and maybe you can't, and who knows? Justin, did I get that just about right?
Oh, yeah. That's Goldilocks. It's Goldilocks all over again. It's beautiful. Yeah.
There are people like Robert Schiller out there who looks at price earnings multiples, but he looks at them kind of in a very special way. Why don't you explain how he looks at them and why that may or may not make sense?
Right. So the problem with looking at price earnings multiples, it's sort of at a year snapshot, is earnings are massively cyclical. And so what he's done is he takes a look at them over a 10-year period. That gets rid of the cyclicality of the earnings. It also means you can use GAAP earnings, so earnings that don't, earnings that have write-offs and stuff like that, because you figure those should balance out over 10 years. So it's sort of a good way of looking at prices over time and making sure that you're not overpaying.
Right. Plus, if you're an economist, you do that just as a matter of, it's like good economic practice. You look at, you do studies over longer periods of time to extrapolate correlations and also figure out, to season the numbers. But if you season the numbers over the last 10 years, you find some big anomalies, right? You go back to 2007, we had a huge blow up in the financial market, which really impacted earnings in 2007, 2008 of the banks. Huge write-downs. So can you use that data still?
Yeah, I don't think you can. If you take a look at that, first thing, that earnings collapse.
By the way, do we have that chart, JR? Do we have?
That's a good chart.
We're going to get your chart there because it's a good chart.
So that earnings collapse was actually, if you go back to 1870 using Mr. Schiller's data, it's the worst earnings collapse in the history of the United States.
All right.
And we also had one of the worst earnings collapses in the history of the United States after the 2000
the internet bubble. So there we go. So there you have, and folks, if you look at that giant red line going down there, that's huge, tens of billions of losses, largely by the large financial institutions in the United States, Bank of America, AIG, which made up a lot of the profits going into, say, 06 and 07 collapse. And then again, if you look at that little blip down around 2000, that is the loss of profits. What?
It seemed bad at the time. It seemed bad at the time.
Compared to 07, 08, it looks like nothing. Right.
Yeah.
Right. So you look at that and you go, look, beware when you look at these PE ratios.
Right. So what I did is we also have, if you looked at that other line that was there,
the black line.
The black line. That is that we get profits data from the Commerce Department that usually matches up with the S&P 500 data. It's profits data for every company in the United States, mom and pops, but basically It's driven by large companies. They use tax data. They use a lot of data.
We don't need to go into the methodology. But when you do that analysis, when you try and season the data, you get the answer that on a historical basis,
stocks are just right.
Stocks are priced just about right now. It looks like the stock market agrees with you, at least right now. It's kind of flat.
Kind of flat. Must have read it. Must have read the story.
Well, it must have read your piece early today, Justin. There is one piece of the analysis which we don't have time to go into, but I will raise it for viewers to think on, which is you should graph that PE chart against what the Treasury yield was in the years in which it was done. And on that basis, when you start looking at bond yields, stocks do look relatively cheap.
Right.
Yes or no, Justin?
I think you need to look at corporate bond yields, and I think you get the same answer.
Very interesting. Justin Lahart, we'll look forward to your piece next week doing that very analysis.